Hi guys, this is Sean Johnston from Centric Wealth Advisory. This is another video of a template that I'd like to go through with you. Some of you are familiar with my templates, have most likely used this template before, but for those who have not, and those who are still new to my YouTube channel videos, I'd like to go through this template with you. This is more of an expansion of the time value of money calculator that I shared in week 1. And the purpose of this video is just to do a bit more of an expansion on that for educational purposes, but also to illustrate how the calculator actually works when you look at it on an annual basis. Because what happens is when you put any calculation into a calculator, this is what it's going to do. And this is how it looks when it actually breaks it down, does all the formulas back end, if I can call it that. And the reason why I've done this is because for educational purposes, it's nice to see how does the future value increase over time? How does my payments increase over time? How does the contributions increase over time? And obviously with the payment periods, when you factor in fees, etc., how does it actually impact the calculation when you're working out the future value if you put fees in? So the first thing I'd like to do as part of this explanation is to put it on 12 years. And I'm going to switch off the growth and the escalations for you. I'm going to show you why I'm doing this now. So first and foremost, let's put on annual and discuss begin and end mode. Now, by default, any payment you make towards an investment is generally a begin mode payment. You make it at the beginning of the month because it's voluntary. You set up your debit order. You're most likely going to make it the first of each month. If it's a payment towards a bond, which is a contractual debt, it's normally made at the end of the month, which is close to a payday. In most cases, it's on your payday. The banks most likely will link the two so that you pay your obligations before your other debit orders. So when you do the calculation for your bond installment, it's always going to be in mode. And I did mention that on the the loan amortization schedule template that I went through in the previous weeks. So I just want to explain that to you that when you do investments, it's begin mode, and you're probably asking, well, what difference does it make? So I want to show you quickly, for those who've not seen this before, is that if you make a payment at the beginning of the year, because it's annual, you're going to get 10%, put 10% in there, sorry, it's part of the explanation. You're going to get 10% return, which is 500 Rand, because it's 10% of 5,000. And that's going to accrue through the first year. That'll carry over to the next year. The next year, it's going to compound and grow 10%, plus the original 5.5. That's going to also grow 10%. You get to 11,550. However, if you made the payment at the end of the year, you're going to have 5,000 Rand because you've not given your first year time to accrue the 10%. It's going to carry over to the second year. The first year's carryover is going to grow 10%, but the second year carryover, because you made it at the end of the year, won't. You're always going to have that 1 year lag. And the reason I just want to show you that is because when you're making annual payments, you're relying on the whole year to grow your money. If you were to make it, let's say, monthly payments, then you would make payments at the end of the month. You would still get your interest accruing per month, but obviously it's just made at the end. So there's not that much of a difference. So if you're looking at, let's just say after the first year, it's 62,828 on end. 63,3, so 351. So it's not a huge difference, but the larger the amounts that you're working with, obviously that makes a big difference. And over time, let's put on 12 years now, it's 1393, 1382. So yeah, there's a several thousand Rand difference on a 5,000. But if you're putting on 20,000 Rand a month or whatever the case is, that could add up over time. Anyway, that's the first thing I wanted to show you. The second thing I want to show you is why it's important, firstly, to have growth in your money, for those who are wondering. And secondly, why it's important to have contributions on your investment that escalate. So the first thing I want to do, which is why I've made this in year 12, is to explain the rule of 72. So the rule of 72 states that if you take 72, and you divide that by 6%, which is we say is inflation in South Africa, your money will halve every 12 years. So what that means is if you invested 600 Rand, 5,000 Rand a month, apologies, and you continue to make that 5,000 Rand contribution, and you built up 720,000 Rand over 12 years. You got no interest, you never escalated your contributions. That means that in 12 years from now, the buying power of 720 would have halved because inflation, the costs of goods and services, rose every year up until the end of 12 years. So it's important to note that putting money into a savings account with very little interest on that is not going to offset inflation. You can see the effective rate and resultant rate is naught, so there's nothing going on. This is not ideal. If you were to increase, let's say you got a 6% return and you got to 1,056,000, then we could say that you've increased your money in line, well, you've increased your money in line or got your growth, sorry, equal to inflation. Because obviously in reality, the cost of goods and services could potentially be much higher than inflation. As you know, medical aids are increasing per year in the double digits. Same with car insurance. Car insurance is increasing quite dramatically. Some are going at 20%, depending on their risk and what claims they've had. So the point I'm making is that one needs to factor in when you do your calculations. But if you took 1056 to see if that would work, 005, divide that by 2, 1056, 005, divide that by 2, that's 528. So it's not exactly equaling the 720. But the point I'm making is that the growth you're getting, so let's say it was 10%, 1396, 1393, sorry, 708 divided by 2, 696,854. So now we can see that you want to grow your money so that you can, just bear in mind, rule 72 is just a rule of thumb. Inflation isn't necessarily 6% in South Africa. It's between 4 and 6 as the target band. But the point I'm getting at from an illustration point of view is if you increase your fund growth by 10%, fund balance by 10% compounded annually, then the value in 12 years would have ideally outperformed inflation because you're now growing your money and that value is increasing at a rate higher than inflation. We could say it's CPI plus 4 as an example. However, the only other issue is that you're making contributions of 5,000 Rand per month. And the issue here, which is why this value is not as high as it could be, is what is the buying power of 5,000 Rand 12 years from now? We've already said that we work on the simple principle of Rule 72. The buying power of 5,000 Rand 12 years from now is 2.5 because we said it's halving. So the contributions you're making is not worth the same as it is today because of inflation. So what's the ideal solution? You put in a 6% escalation. So you get a resultant rate of 4.22%. So that's taking 10 minus 4, but then you perform a calculation and you have to use the effective rate to do that. The effective rate, if you go to the time-dated money template, there's actually a calculator for that. But essentially, the effective rate is based on the number of payments and the interest accrued per payment, right? That's where that effective rate comes in. So now, you look at 1.829 versus 72. So, if we take 1829, 786 minus 720, we've got a 1,109,000 Rand additional growth. So this is where you would start to outperform inflation in real terms. So when you start buying goods and services, you would have an adequate fund balance to actually live off. And the reason for that is because the resultant rate is what you're growing your money by is 4.22%, which is essentially what we can say is the real return. Because we're taking the 10%, we factor in escalations, which we're saying is in line with inflation, and the resultant rate is 4.22%. If we didn't have escalations, I can show you the impact. It's 1.829 versus 1.393. So it's quite a big difference because this is not keeping in line with inflation. At least the fund balance is, because it is growing. So I want to share this with you because it's important to note what is the buying power of my money in the future when you're making payments towards an investment. So ideally, even if you start off with a smaller amount, not necessarily 5,000, it might be 4,000, but you need to factor in escalations. It doesn't have to be 6%. You can make it a lower amount if you want. And the return obviously depends on the asset class that you're going to. Ideally, you want to have exposure to equities, local, offshore. You want to be exposed as much as possible to growth assets so that you can get the best compound return. We are working on 10%. I've not put fees in. Let's put a fee in of, let's say, 1.5%. Obviously, you can see the impact over there. But the idea behind the fee, of course, is if you go into a fund and looking at 10%, 10 minus 1.5, which is going to be calculated over here, taking the growth rate, which is 10 minus 1.5 to get to 8.5. This does exactly the same calculation. This is the time value of money calculator, and this is a different one where I'm actually physically drawing the money through, adding the interest, working out the present value, and working out the future value. So this step over here is here. This step over here is here. So we are working out, there's the 416, there's the 416. So basically what I'm doing is I'm replicating the calculation, but I'm just extrapolating it so you can see how it actually grows every year. So it's really quite nice for educational purposes. And you can make any value you want. Let's say it's 20. And if you want to go even further, just note there's a graph at the bottom. This graph is quite powerful because it actually shows you the impact of consistency, compound interest, and just staying committed to the plan. So 37 years, your fund balance at the end of the year was 62,836. Let's just make it a bit more realistic now and say the increase was in line with inflation, your salary, or 4%. Okay. So it's 62,836. No escalation because the escalation it takes at the end of the year. Your future value after 37 years is 24.76 million. Now, in layman's terms, you have grown your wealth quite substantially. That's 37 years. So there we go. You have grown your wealth quite substantially by making a 5,000 Rand payment, escalating that at 4%. That's in line with the salary, just consistently doing that, not touching that money, and getting a 10% compound return. And I factored in a 1.5% fee to get to 24 million. Now, because I've shown you already the factoring of escalations, the growth, your resultant rate is 4.65. I do understand that it's not, that's the growth rate, maybe not necessarily 6%, but again, you could be exposed to offshore. I do have a separate template I'm going to share with you where instead of investing in South African rands, you can invest directly offshore. And then you have a different growth elements because you're getting the growth abroad in their funds and you're factoring in the depreciation of the rand. What that simply means is if you invest money abroad at a certain exchange rate, if you go to the exchange rate template that I shared previously, you will see what I mean in week 2. And you then have the rand depreciate from, let's say, 17 Rand to 20 Rand over a 5-year period. You benefit from that depreciation because when you convert it back into rands, You times it by 20, not by 17 when you bought it in. And of course, you're getting the growth. But let's just work on 12%. Let's say you went into a diversified portfolio. Obviously, it's a linear return, so there will be years where you get below or above, but let's just work on 12. It's a volatile asset class mix, but the whole point of that mix is to get maximum returns. Higher risk, but maximum returns. Because remember, we're investing for the long term. We're saying it's 20 years, but after 37 years, you're getting 39 million. The contributions are the same. We've just looked at the growth of the funds because you've got a financial planner that has put you into an asset class mix that's got local, offshore, etc. Obviously, depending also what vehicle you're in. If you're in a retirement fund, you've got regulation 28, but you do have 45% exposure offshore. But the point I'm making is this is where a financial planner can add great value. Obviously, just bear in mind that fees will most likely come down the more assets you have. The 1.5% is just carried through the entire cash flow. Can I say this? Because at Centric, for example, we charge a lower fee based on the assets that you have under management. And obviously, if you're starting off at 1.5 initially, that might drop down to 1% in the later years. I'm not tiering this. I'm not doing any special calculations for that. It's just purely for illustration purposes. But the idea behind this is that we just want to show you the long-term implications. If you click on the macro here, the button to expand the portfolio, you can actually start looking at 71 years. And yeah, crazy. Starting off with 63 and you're getting to 1.49 billion. It's yeah, that's the power of compounding, really. Staying committed. So if you invested for 71 years, let's say it was a trust, and the trust was making contributions and just consistently did that for 70 years, you'd have a massive amount of wealth. And that's just something I want to touch on now is wealth is really generated just through consistency and being committed, really. Wealth is not starting a business and trying to become Elon Musk. Huge risks involved there. It also does not entail taking massive risks of putting your money into unregulated funds or mechanisms. Cryptocurrencies has been a topic of talking point for well over a decade now. I do understand the mechanism behind the decentralization of the blockchain. The whole point of blockchain was to create a lot more safety because you're looking at ledgers. There's a lot more security regarding the blockchain compared to centralized banks where there's potential fraud. That's why you always see these warnings and notifications and phishing emails come from the banks that has to warn you, it's not us. The crypto blockchain is very secure because you need confirmation across the ledgers, etc. There's lots of learning material that one can study to understand that better. The whole purpose of blockchain, just by the way, was to transfer from one wallet to another. No one was ever meant to hold the crypto, but Bitcoin was the original one. And what happened was, people held on to the crypto. And as a result, Bitcoin, because there was only a limited amount of Bitcoin available, more and more people started buying. And as a result, simple economics, supply and demand, limited supply, high demand, the price goes up. So those who bought the Bitcoin in the very beginning, they've made absolute fortune because the price of a coin was fractional. Today, the cost of Bitcoin is just, depending obviously what's going on, is quite expensive. And that means it's unattractive. So what's happened is over the last decade, there's just been hundreds of coins being introduced. Some of them are stable coins, some of them are meme coins, some of them just have no value whatsoever. But what I don't like about the crypto coins in general is that there's zero intrinsic value, which means that when you see a price of a coin, like a share going up, you cannot work out where that came from, other than supply and demand and maybe hype. And what I mean by that is if you have an increase in the share price of a stock on any listed securities exchange, you can go and get information from that company and see how that was derived, because they've got their financials there, they've got the balance sheets, assets, etc. You can go and do. That's why analysts exist, for that reason, especially for asset management and portfolio management. But you cannot do that for a crypto, because basically someone can make a tweet and say, invest in this coin because, it's going to be huge growth. What happens? Everyone jumps on the bandwagon, goes and buys in that coin. Nothing is stopping the person who made that tweet from selling later down the line. When he bought in low, sold, and it was at a high price and made his money, leaving everyone else who bought at the end losing out because they've bought at such a high price. The price drops because, again, basic economics, your supply goes up and your demand will go down because obviously people are selling. And as a result, people are left with a much lower price waiting for the next, what they call pump and dump. Someone has to hype the price and hope for the price to go up. If you watch The Wolf of Wall Street, that exercise was done with Steve Madden. If you get to that part where they did a pump and dump, that is illegal, unfortunately. Well, fortunately in this case, because you don't want to invest your money in unregulated funds. And that just simply meant that they hiked the price of the share for Steve Madden and sold. So a lot of people lost money in that process, but they built up all that wealth, which again is illegal, securities fraud. And unfortunately, you've got to decide as an investor, do I want to go into a regulated fund or do I want to go into a fund that's really just gambling, in my personal opinion? A lot of people might have made money. I've made money through Bitcoin over the years, but because I understand the mechanism of the whole process, I wouldn't rely on my retirement planning on that, simply because there's just too much risk. And also, Centric does have crypto assets on their license, but we are only advising on crypto. We're not going to sell crypto because there's no intrinsic value. Charles McAllister is not going to ever recommend cryptocurrencies simply because he cannot understand the rationale behind that. And he's a very smart guy. So if he's not going to do that, I'm not going to do that. And secondly, as an investor, it's in your best interest to have regulated funds where there's repercussions should your money get magically taken, because there are rules in place, acts in place, watchdogs in place that ensure that if your money goes into your fund, there are regulators that hold asset managers accountable, because they have to register all their funds on the FSCA. They have to be above board. Everything has to be legal, is the point I'm getting at. And that's why it's important to work with a financial planner that is accountable, and secondly is registered with the FSCA as a representative, because they're held accountable for the advice they're given. And as a certified financial planner, we hold to a high standard, which means that there is no leeway whatsoever if we give bad advice, if we're not transparent, if we don't disclose certain information, because the ombud for phase will basically state you're a certified financial planner. It's your job to know this. You've got the certification, you've got the qualifications, you've got the experience. You're supposed to be doing your 35 hours of CPD points per year. If you are doing that and you're giving incorrect advice, unfortunately, you're at fault. There's no such thing as negligence when you're at this level. And that's why I do recommend people getting their CFP designation, because it puts you amongst one of the several thousand in South Africa. There's only, I think, if I'm not mistaken, it's just say 5,000 for argument's sake. But there's over 100,000 representatives giving advice in South Africa on products. So if you look at the ratio, and of the 5,000, not all of them are practicing certified financial planners. They might have it as a separate designation, but they're an attorney. So they're not giving financial advice on the products. They are doing estate planning and other legal related matters. They just have that designation as part of their value proposition to clients, because they don't understand financial planning law. So that's the reason why these templates exist. This is why we are trying to educate people to make the right decisions, and also to, upskill everyone so the entire industry benefits, because quite logically, if you've got 100,000 plus representatives and increase the number of certified financial planners, the voice of the advisors become a lot more powerful to change industry so that there's better fee structures for advisors, not just commission only, with clawbacks and things like that. It could be a fee-based system. It could be a system where it benefits the advisor, it benefits the client, and the entire industry benefits, because then the clients are getting better service, they're getting better products put in place, and incentives for financial planners is not driven by volume, it is driven by quality. So it's not quantity that they are looking at, it's quality. Because most insurance companies award financial planners for how much business they make them, because that's how they make their money. They make investment floats through additional contributions that they gather over the years from investors who are investing in retirement annuities, endowments, life policies. All of that is accruing into the life company's bank accounts, and they have to then offset that in what they pay out as claims. And simple as that. That's exactly what Berkshire Hathaway does for Warren Buffett. It's an insurance company. Anyway, the point is that as time goes by and these templates start becoming a bit more advanced and useful, your value proposition, regardless of your status, doesn't matter really, is to be more well-informed so you can ask the right questions for clients, but also gather the right information, prepare the right plans, and also just question the whole system. How does everything work? How do you build wealth for your clients? What are the fees that our current suppliers are charging? If you're let's say, a commission-only advisor, put the fees in, see what it does, and start questioning, okay, well, is this the best product I should be giving my clients? If you are an ethical advisor, that's the thing you should be doing. But the point is, this template will empower you to do that. I'm going to also just leave the time value of money template that I've created, because in any scenario I've done here, just bear in mind that the time value of money template doesn't have biannually and quarterly. I've added that in on this template, but it will do the same calculations as the ones that I went through on that template. The future values will be identical, and I know that because this is exactly the same calculator. I've copied and pasted it, the one that does the monthly payments that escalate per year, and I've worked out the same future values and linked it to this. So I know that the two will correlate. Thanks for taking the time to go through this video. I did ramble at the end. Apologies for that. But I just think there's some important things that I want to touch on. Being a certified financial planner, working for a company that is completely client-centric, everything is disclosed. Fees, processes, everything is made perfectly clear to the client, because we don't want to have any recourse. We don't want to have any issues down the line. We want to mislead clients. And obviously, the whole point of this exercise is to build relationships so that clients will continue to invest with us over the long term, and also introduce other people to us that we can assist in their families, so we can add more value to the South African population. And you also want to upskill other financial planners, because there's only so many clients a certified financial planner can take on and service properly. As Charles says all the time, there are only so many parking bays in your garage. You cannot take on hundreds of clients in your career and try and service them correctly. It's impossible. So he's got a narrow amount of clients he works with. Obviously, there's a certain type of client that he will advise, but he does not have hundreds of clients preparing dozens of reviews every week. He hasn't got the time for that, but also he focuses his skills on the right people, and he has done exceptionally well over the last few years as a result, which is what we all aspire to. And I'm going to share some of that knowledge as these videos go on and other videos we make. We want to try and empower people to get to that point so that you are in the best possible position to help clients professionally, ethically, but also financially. Thanks again. Hope to make a video again in the near future. Ciao for now. Bye.